So I did my first SPAC 2.5 years ago. When I did my first SPAC, or the first one in Silicon Valley, I'd explain to what a SPAC was. I mean, no VC knew what a SPAC was. Anybody who knew what a SPAC was had a bad connotation of it, because SPACs back in the days were something that, especially private equity guys, would spin up a SPAC to sell an asset that they couldn't take public, and then they'd leave the shareholders holding the bag while they took off, because they were selling $10 a share, but they were in it at pennies on the dollar. So if it dropped to $5, what do they care? They made money, right? So the SEC actually frowned upon SPACs and put all kinds of guidelines in place that if you create a SPAC, you can't be self-serving. You can't create a SPAC to spin out your own asset, right? You actually should not know what you're about to buy when you start a SPAC. So you come full cycle now, and SPACs are going crazy, right? There were 200 SPACs in January, there were 300 in February, and now there's 400. There were 35 last week trying to de-SPAC. The week before there was 25 trying to de-SPAC. De-SPAC is a process where once you've raised the money and you found a target, then you try to de-SPAC by buying that target. It's an acquisition. So it is quicker to go public with a SPAC, but you have to be ready to be a public company. Yeah, and Tony and his team will tell you, you got to be PCAOB compliant. You have to be ready to be audited to those standards. Otherwise, you're not ready to be bought by a SPAC. And so a lot of people are getting caught short with that. A lot of people are not doing proper due diligence. Director of a public company, which you are when you sign on to be a director of a SPAC, you have responsibility, you have fiduciary responsibility. Don't let anyone fool you into thinking, this is an easy way to be a director. No, you have fiscal responsibility. You are responsible for the veracity of the books. You are responsible for the acquisition that's made. And so you have to treat this like a real public company, because it is a real public company. So we're here because people, realize it's quicker to go, and it's quicker. The big distinction is in a SPAC.
The way I look at it is, the duty of due care, due loyalty is the same for SPAC. And obviously the level of disclosure is something that you need to be very aware of. Structure are very different. Obviously, there's no operational aspect of the company. You really need to understand the sponsor behind. I think Lloyd made a very strong point on that. Is there a reputable, credible, well-established team that has a deep industry expertise, and they're going to be in this for a long term? They have M&A capabilities that they can do a wholesome due diligence. Or literally, I have SPACs that approach me saying, well, we already have a target, which they're not supposed to. This will be just a couple of months, borrow your name, and then, you can go. It's like, oh, wow, that's pretty exciting. It's fast moving, it's dynamic. But then what happened to your reputation if you care? So I do see reputation as a director as one of the major consideration with SPAC. I look for SPACs that I know the institution behind it. I know the sponsor behind it. They've been together for a long time. They have done other deals, either as a private equity or venture investor. They have, acquisition talents on board. They have industry depth that they are tapping into on the target base that they're looking to be SPAC. So all those are clear ingredient, of course, all comes down to people.
Being on a public board, a traditional public board, versus being on a SPAC board with the expectation of a roll-off on de-SPAC is not only a different animal, it's not just apples and oranges, it's like apples and scissors. It's a totally different beast here. Being on a public board, the way Lloyd and I think about being involved, and you, Claudia, for your entire career, think about being involved with companies is we get involved. I always say it's the difference between being a builder versus being a banker. We're trying to get inside the company and really be a partner to help grow the company. And, you reference one of our companies, but in all of our companies, we are long-term partners helping the company achieve its strategic objectives, not over a quarter-to-quarter basis, but in our case, and in most, when people think about going on public boards, over the very long haul. The SPAC board context is actually one of executing a short-term, one-time transaction. And so in many ways, these are boards that function much more like an M&A team. Mm-hmm. They're trying to identify a target, they're trying to structure a deal, they're trying to deliver favorable economics to stakeholders over a relatively short cycle of the SPAC, de-SPAC, and the exit post-lockup. And as you said, there's many of these target board members who are going onto the SPAC boards, often for reputational name or other purposes, but without a mindset of this is going to be a company that I'm going to be part of for many years and help guide and be part of a strategic direction and organizational build long haul. The rationale for SPAC board member recruit, and in fact, the way in which a lot of the SPAC board members are going on is different than the way you're describing what it should be and the way Lloyd and I operate. There are a lot of, unfortunately, a lot of examples of this shorter term horizon. And look, at the end of the day, part of this is, even with the best of M&A skills, in many of these cases, these are shotgun weddings. Yeah. This is not due diligence done over a long haul. In many cases, these are shotgun weddings. And so, as to your point, the risk as a fiduciary in a shotgun wedding like this is just different than what a long haul investor and someone who's done serious diligence around a company in both the private and ultimately public markets do. I'll just add, look, it is true that ultimately the stock price rising, we view as a result of a successful outcome, a successful transaction, but it really comes down to having a team that's ready with predictability of forecast and a predictability of business model. And when that happens, you are able to achieve a stock price result. But one of the reasons that I think a lot of the fundamental investors really have a jaded eye is because most of the great public investors are not actually trying to arbitrage over the short term. They're trying to invest in great companies over the long haul. And so one of the successful dimensions to building out a transaction in the space, like an IPO, would be to get long-term shareholders and identifying a shareholder base that is going to believe in a story, believe in a team, be part of a long-term journey, as opposed to having massive shareholder turnover, is a really important dimension to making this a successful outcome. Again, not over days, weeks, months, quarters, but over the much, much longer horizon. And there's the good news is we've talked about the pitfalls. We've talked about a number of companies that are going through this process that probably shouldn't be and don't deserve to be, including, and SPAC sponsors the same. But let's also make sure we're also highlighting there are companies out there at the other end that actually do fit the profile of deserving to be public. There being a number of reasons why this is a better path, and having a set of dimensions that would make a traditional IPO successful. They're mirroring through this process as well.